Good afternoon, everyone. If you're joining us from Europe, and good morning to those of you who are joining us in the United States. My name is Leslie Shulenta, and I'm here to welcome you to our webinar today, which is about the financial crisis in Europe and the potential that it might spread contagion into Southeast Europe and Eurasia. Thank you all for joining us to talk about this very important topic. I'm really glad that you were able to join us today. The purpose of this webinar is to cover the issues that were discussed in a paper that was produced by Partners for Financial Stability program, which is a USAID program for financial sector development in Southeast Europe and Eurasia. This paper is what we call a technical brief. It's the fourth in our series of technical briefs, and all of them relate in one way or another to the financial crisis from 2008 and the ongoing crisis in Europe, which is still plaguing us today. I would like to just provide, first of all, an overview of what today's webinar is going to cover, and I'd like to introduce you to our team who will be doing the presentation today along with me. You will have a chance to ask questions, and you can do that by actually speaking into your microphone or your telephone, or you can send them in written form, and when we get to the end of the presentation, when we have the question and answers, we'll give you instructions about how to do that, how to submit your questions if it's not clear to you. And first of all, today we'll be covering for just a moment what is PFS, the Partners for Financial Stability program, and then we'll be talking about the financial sector and the role of the financial sector in economic growth, and why it's so important to protect and maintain the health of the financial sector, particularly in the target countries where the PFS program is active. Then we will talk, then I will hand it over to my colleague Scott Calhoun, who's also from Deloitte Consulting. Deloitte is the implementer of the Partners for Financial Stability program. Scott will talk about some of the particular challenges of the European debt crisis and why these are so important to the economies in Southeast Europe and Eurasia. Then Scott will continue on to talk about the possible effects of the economies in Southeast Europe and Asia, what actually is likely to happen in this region as a result of the economic crisis, the debt crisis in the Eurozone countries that's ongoing today. And then we'll be joined by our colleague Lori Bittner from Deloitte, who will talk about what USAID can do and what policy makers can do to try to address these risks. We can't really stop it from happening, unfortunately, but there are certain things we can do to try to be aware and to try to be prepared, not just ourselves, but the stakeholders in the countries that are affected by this potential crisis. And then Lori will also summarize what's been covered and draw some conclusions from all of this, and then you will have a chance to ask your questions. And I hope this is all going to take somewhere around an hour and 15 minutes to an hour and a half today. First of all, just a word about the Partners for Financial Stability program. This PFS is a regional project which is handled by the Europe and Eurasia Bureau of USAID in Washington. And PFS was designed to address the challenges in Southeast Europe and Eurasia that arose from the financial crisis in 2008, and to implement best practices in the financial sector in the region, and basically to support the financial sector in a number of ways in order to ensure that financial sector is actually supporting economic growth rather than dragging down economic growth in the region. You can see in the two dark blue boxes on this screen the partner countries or the beneficiary countries where the Partners for Financial Stability program is active. We cover 12 countries, 6 are in Eurasia, what USAID calls Eurasia, and 6 are in Southeast Europe. We also have 12 mentor countries. These are countries that we call mentors. These include the 10 EU member countries, the new countries in Central Europe that joined the EU in the last several years, and also Croatia and Russia are on that list. And many of the things we do in PFS, we try to involve the mentor countries as well as the partner countries or the beneficiary countries. So we actually bring together stakeholders, for instance, financial sector supervisors from the partner countries with their peers from the mentor countries to share knowledge and experience and to support each other as they face down the challenges in the financial sector in the region. And I don't know if I said so, but I'm the Chief of Party, the Project Manager for Partners for Financial Stability Program. I'm actually speaking to you today from our project office, which is in Zagreb, Croatia. And my colleague Scott is calling into the webinar from Florida. And our colleague Lori, who will also be speaking to you in a few minutes, she's calling in from Washington, D.C. Now, just a few words about the financial sector and its important role in economic growth. Economists agree that the financial sector is important for increasing economic growth and for reducing poverty in emerging markets. The financial sector provides credit and capital to individuals and businesses so that they can grow and expand. It also provides a safe place for individuals and businesses to save and keep their money, invest, and earn. It facilitates payments between different entities in the economic system and provides other types of financial services. And all of this leads to or fuels the exchange of goods and services in the economy. Without the financial sector, it would be very, very difficult for many of the normal everyday activities that we all take for granted to actually take place. And the literature tells us that in highly undeveloped economies, or let's say the poorest countries of the world, the financial sectors in those countries are always very small and underdeveloped. And there's a direct correlation between increasing wealth, increasing standard of living, and the growth and the sophistication of the financial sector in a developing economy. Supervising the financial sector and keeping it safe and sound is always very important, and it's even more of a challenge in emerging markets than it is in a developed country such as the U.S. or in Western Europe. But it's very important for achieving and maintaining macroeconomic stability and for maintaining access to finance and investment, especially for small businesses. We know that when the financial sector is under stress, that banks tend to cut back on their lending, and this can be devastating for businesses which rely on bank credit to fund their ongoing activities and to increase their business and to create jobs and to stimulate economic growth. Now I would like to ask Scott to join in and to say a few words for us about the challenges of the European debt crisis and what it actually means to the PFS beneficiary countries in Southeast Europe and Eurasia. Scott, are you there?
I'm here. Thank you, Leslie. I just would start by saying if the rest of you are like me, I'm getting a little fatigued about reading about financial crisis, which we've been reading about since the 2005-2006 time frame when we started hearing about the subprime crisis in the United States, which subsequently grew, and then with shocks in late of 2008 in the marketplace, this transmitted into emerging market economies. And certainly those countries that PFS works with were many of the countries that were severely impacted both on a macroeconomic level as well as some of their financial systems saw dislocations. But that as an outgrowth of that, we have for the last 2 years been hearing about the European debt crisis. And unfortunately, that is still with us. There were real hopes a few weeks ago that a plan announced in the time frame around the G20 meeting and subsequent to that by European leaders, those in the Eurozone in particular, about actions that were being undertaken or planned that would help stem the problems of this, the concerns about sovereign debt crisis in the Eurozone. Unfortunately, those haven't materialized, and in fact, market conditions have deteriorated more since that time. And as we saw some rather substantial interventions last week led by the U.S. Federal Reserve System with a number of central banks to increase the liquidity for European banks, the Western European banks, that were suffering real liquidity strains. And just as a context point, I would say that the many of the Eurozone banks, the pan-European banks, are heavily reliant for some time now on using funding from the ECB, the European Central Bank, to help fill those gaps because they are so dependent on wholesale funding. So what does all this mean for those countries that PFS works closely with? And clearly there will be impacts. There will be pain that will be felt from this phase of the debt crisis. To put it in sort of maybe a point on this, the severity and the length of those pains will be dictated on whether or not the current challenges are handled in an orderly way, or if these things get resolved in an unorderly way or a disorderly way. Right now, the key stumbling block, I will call it, to resolving this problem is one I would say is of political dimension to this, and that it really needs strong, decisive leadership from Eurozone leaders in order to be able to stem this problem with the remaining time that exists, although time is running out. So why is this a factor for the PFS countries? Well, that a number of the countries, particularly those countries in Southeast Europe, and I would also mention the Ukraine, more so than other countries in Eurasia, but Southeast Europe and Ukraine, there are very strong linkages to a number of the pan-European banks, with many of these banks operating from Eurozone countries where their parents are, so that they have close linkages to these pan-European banks. The other is there's very strong trade linkages between many of the countries, and particularly in Southeast Europe and the Ukraine, but also in a number of the Eurasian countries. There's bilateral trade with a number of the Eurozone countries. And as these problems continue to mount, that places greater pressure on these countries in terms of, a second round of recession perhaps. And the downside to that is, as there are slowing economic growth in some of these Eurozone countries, it will reduce the demand for product and services from the countries that we work with through PFS. So the trade linkages are a second part of this. And that there are a number of countries that for the last 2 years, and as we look at this current environment, have a weaker macroeconomic and financial stability picture than they did before the crisis that hit in 2008. So we're seeing these three things we think make this a real vulnerability for a number of the countries, and I continue to say particularly those in Southeast Europe and the Ukraine that have very close linkages both through the banks and with trade. So if we can go to the next slide, perhaps, Leslie. So I mentioned the banks already, and that the parent banks for a number of the significant banks in a number of these countries, particularly in Southeast Europe and the Ukraine, a number of the larger banks in those countries are controlling ownership by a pan-European bank franchise. And that for a number of these banks, that historically the growth that they have experienced has not all been funded through deposits, but rather also through advances that were coming from the parent company, whether that's in Austria, Italy, France. These were also advances or loans from those parent companies to help fund the growth in these Southeast European and Ukrainian countries. So that makes these banks in the countries that PFS works with more dependent for liquidity and funding purposes on advances or loans from the parent for their operations. Without those, they have to, in fact, reduce their operations. And this is something that I'm speaking about in addition to capital. Now, as you look at those parent banks, whether it's Italy, France, Austria, Germany, whatever country, many of those parent banks have substantial exposure in their portfolios of assets that are bonds or debt instruments from these distressed countries that are in the Eurozone. And we saw most recently where agreement was reached that for Greek bonds, that there would be a 50% write-down in the value on those. This places real strains on capital at the same time that by June of 2012, many banks are expected, these pan-European banks, operating under European standards and the Basel implementation for those banks, are expected to raise their capital levels. So at the same time they're raising capital, there may be higher losses from sovereign debt, but for a number of these banks too, they also have private sector exposure in these countries that may also affect them too in terms of write-downs that have to be taken, whether that's a Greek company or a Greek borrower or an Italian borrower. So there are real strains on the parent banks where it's unlikely they'll be able to continue making loans that will be able to expand or increase growth in the emerging markets that we focus on in Southeast Europe, Ukraine, and Eurasia. So the parent bank challenges, just very briefly, write-down of sovereign debt, the increasing of capital, the fact that under Basel III implementation, they're expected to create greater liquidity reserves and more capital for liquidity. So there are also going to be liquidity stresses, and currently that has been extremely challenging. I mentioned a few minutes ago, a number of these banks are relying upon the ECB to help with their funding, and that we have seen in recent weeks where the interbank market for Western European banks has been in a freeze, and it's been very difficult for them to fund their operations through the wholesale markets. So in looking at it, how can this affect the downstream banks or subsidiary banks that operate in these emerging markets of Southeast Europe, Eurasia, that there may be a need to reduce or sell assets. There is more limited capability of the parent to be able to provide liquidity, and that it may result in these subsidiary banks having to cut credit lines. So there could be liquidity strains both for those banks in these emerging market domestic interbank markets. So Leslie, I think we can go to the next. Just to get a picture of the presence of some of the pan-European banking franchises, you'll see across the top of this a list of the countries that we have selected, focusing and a break between Southeast Europe and Eurasia, and you'll just see some of the Greek, Italian, Hungarian, Austrian, French, Slovenian, and Russian banks that operate in these countries. And you can see that with the Ukraine and in Southeast Europe, there is a much more significant presence. And so these are the countries that my comments have focused, that these are particularly vulnerable for linkages from the perspective of the financial sectors to developed Europe and the Eurozone. And on the next slide, I believe, we'll have a picture of the bilateral trade for a number of the countries. So if we just look at, for instance, Albania, what is the bilateral trade they have with Italy, Spain, Greece? It shows the percentages of GDP. And when you look at the total for EU trade, Albania has just under 30% of GDP is with bilateral trade with EU countries. So there are significant trade linkages also that as these economies in the Eurozone perhaps slow, this can have an impact on the economies and certainly the demand for services and goods from the countries that PFS works with. Leslie, I will pass it back to you.
Okay, Scott. Yeah, thank you, Scott. I would like to mention the third area that Scott talked about. He said that the countries that are most exposed to the sovereign debt crisis in Europe are those that have connections through their banking sector with these Eurozone banks, those that have high levels of trade with the European Union economies, especially those vulnerable countries like Greece and Italy. And the third factor was the financial sector and macroeconomic stability in the countries themselves. So those countries which already have, let's say, weaknesses or vulnerabilities in their macroeconomic situation and their financial sectors are also going to be highly exposed to any potential contagion or fallout from the crisis in the Eurozone area. And you can just see a couple of indicators on these charts here that speak to the macroeconomic vulnerabilities and the financial sector weaknesses in the target countries where Partners for Financial Stability operates. In terms of current account balances, you just quickly see that most of the countries throughout Central and Eastern Europe have current account deficits, and some of these are really, really large. Montenegro stands out in a case by itself on this chart. Many countries have such high current account deficits that economists consider them unsustainable. That's just one indicator of their macroeconomic vulnerabilities. And if you look at the banking systems, one indicator that tells a lot about the health of the banks is the level of non-performing loans as a percentage of total loans in the banking sector. You can also see that in most of the countries across Central and Eastern Europe, particularly Southeast Europe and Eurasia, that the level of problem loans, non-performing loans that are not repaying according to their agreed terms and conditions is very high. In a few countries as high as 20%, and on average higher than 10%. You can see on the far right-hand side of these charts the global benchmark, and we've actually taken the Eurozone average as the global benchmark for these two indicators, which means that even the Eurozone countries, which are actually pretty weak right now, have much lower levels of non-performing loans than the majority of the countries where Partners for Financial Stability is focusing. So based upon these three factors taken together, the macroeconomic and financial sector vulnerabilities that I've spoken about, and the trade linkages and the linkages through the ownership of the banks that Scott spoke about, in our opinion, the countries that are most likely to be hit hard by the problems in the European Union right now are Montenegro, Serbia, Albania, Macedonia, Bosnia, and the Ukraine. When you take these three factors together, those are the countries that really seem to have the highest level of vulnerability. I'd like to just say a couple of words about Montenegro and what happened there in 2008 as an example of how things might turn out this time around. you may be familiar with what was called the Vienna Initiative, which took place end of 2008, beginning of 2009. This was a series of agreements that were patched together by the EBRD, the IMF, and some other international organizations, together with the central banks in the affected Southeast European countries and the parent banks from these pan-European parent banks that are so crucial to the countries in Southeast Europe and some other Central European countries. And in the Vienna Initiative, the parent banks agreed to maintain their exposures in these countries, which means that they would not ask to have big dividends paid to them, or they would not ask to have their loans to their subsidiary banks repaid in the midst of the crisis. Had they done that, we could have really seen a systemic banking collapse in the Southeast European region, in particular in the 2008-2009 crisis. What happened in Montenegro in that time period was a special case because they didn't manage to become part of the Vienna Initiative, and they didn't have these agreements in place whereby the parent banks promised to maintain their exposures to their Montenegrin subsidiary banks. And as the crisis unfolded, initially these parent banks from the Eurozone countries provided support to their subsidiary banks. They actually lent them more money to help them get through the problems that they were experiencing. But there was a huge pressure on the Montenegrin banks. When the depositors started to withdraw their money, there was really a full-blown run on the entire banking system. And the parent banks supported the banks during that period of time. But as soon as the deposits started to flow back again into the banks, those parent banks from the pan-European countries actually withdrew their support and asked to be repaid for some of their exposures by the subsidiary banks. And so as a result, Montenegro's banks actually had to cut back lending substantially. The lending in Montenegro decreased by about 20% in 2009, partly because bank deposits had declined significantly, and partly because the Montenegrin banks had to repatriate funds to their parent banks in the European Union. So Montenegro was actually one of the hardest hit countries in Southeast Europe during that crisis. This is the type of thing that we hope is not going to happen again. Now I'm going to ask Scott to relate one potential issue from an example that we've taken from one bank which is owned by a pan-European bank. Scott?
Thank you, Leslie. I think that, as we're talking about, when you start looking at the financial sector in countries that PFS works with, sometimes what appears obvious may not always be obvious. And what we wanted to do is just show an example here of that it can be a little more complicated than what you see on the surface as you look at what may be going on and where trouble spots may be. Now, you have UniCredit Bank in Serbia, which I think most people might recognize UniCredit as an Italian institution and think, oh, that if, for instance, if a supervisor was looking at this, a banking supervisor, they might say, oh, well, in exercising home country, host country supervision, well, it would be Serbia and the bank regulators in Italy that would be sharing information and doing information exchanges, and if there's a resolution that needs to be done between those two. But it's a little more complicated than that. In this instance, we just show that if you look at Unibank Credit in Serbia in the graphic, bottom box of the graphic, it's 100% owned by UniCredit Bank Austria. So the parent bank is actually an Austrian entity, and that the Austrian bank is just under 100% owned by UniCredit Group from Italy. So while we think this is an Italian bank, actually the ties from the ownership perspective are for an Austrian entity. So as we're looking at this, if the Unibank credit in Serbia wasn't getting the downstream of loans from the Austrian entity, which they then on-lend or pass on to borrowers in Serbia, they would have to repay that loan to the Austrian bank. It's just trying to, this illustrative example is trying to say that the lines of communication, information sharing among regulators in different countries, it can be a little bit complicated. And I think the other point to think about that as you're looking at these kinds of issues, when you're talking about a crisis and potential fallout from the crisis, it raises the question of if in fact you had to start taking actions where there was a liquidation involved, what countries would govern the decisions about whether that's bankruptcy or legal. Clearly Serbian laws would apply, but as somebody looks to follow this from a perspective, is it also Austria's or is it Italy's laws that govern this? So there really, it can be much more complex than what you might think on the surface is very obvious. And so this is really just an example to show you that it takes digging into these things to really get behind where are the exposures and how do you resolve these things, and how do in fact regulators need to work together, which regulators, and information sharing among regulators. Now we've talked about if there's a crisis, and we would like to suggest to you and for the discussion speak to the fact that there's two likely ways in which the fallout, as we started, we said there will be pain. The question will be, will this pain come in the form of an event, which would suggest that it will be a shock and that the impacts will be immediate and the pain will be immediate? And in that type of a scenario, the sequence you would see is that the financial sector is a very likely transmission channel for that type of a shock if it comes from the European debt crisis. So the first thing would be there would be a liquidity freeze or a liquidity crunch. And this clearly, if you look to the right, suggests that there would be lending curtailed. The question in that loop, though, is if it's a financial sector transmission, does it in fact require that it's going to take some kind of intervention from the central bank, whether that's providing additional liquidity to these banks, or it could ultimately mean there could be an instance where it requires some kind of a resolution or intervention by regulators or by the central bank in order to make sure that liquidity stays in the marketplace. So the first shock would be liquidity crunch. It leads to lending being curtailed. There might be an interim step there. Clearly, you would think that the central bank would have to do something to help support liquidity. But at the same time, too, would it also require supervisors to intervene? This would then, if you curtail lending, lead to a slowdown in the real sector, which clearly is a negative, especially since many of these economies are trying to recover and go back to economic growth models based on the last crisis, and this would be a real setback to either take away growth or, in fact, perhaps return some of these countries to recession. This slowdown of lending to the real sector would also then lead to private sector illiquidity and insolvency. I think if we can go back just real quickly, Leslie. Sorry about that. It would lead to private sector illiquidity and insolvencies, and all of this would lead to a declining economic activity. Okay, now we can go, Leslie. Thank you. The second scenario is if it doesn't come in the form of a shock or an event risk, most likely the transmission channel might not be the financial sector, but it might be through the economy, through trade that collapses or trade that significantly falls back. And in this case, you would have slowed economic activity, and that would lead to private sector illiquidity and insolvencies, and those insolvencies would certainly, and that illiquidity would lead to a slowdown in the real sector, and this would mean that there would be much slower loan repayment and perhaps default, and at the same time this would probably be seen from the banks getting tighter in terms of credit conditions and lending, and this would lead to elevated problem loans and additional losses from either defaulted loans or the need to write down assets, which ultimately leads to weaker and insolvent banks with less capacity to lend. And the loop in there is when you have elevated problem loans and losses, is there a need for government assistance or liquidation for any of these banks? So the financial sector clearly in the shock scenario could be the transmission channel, and if it comes through the economy in a slow and protracted scenario, the financial sector will certainly be impacted, but it will be a bit longer in terms rather than a shock, but it will lead to weaker bank solvency concerns and higher credit losses. When you look at this, whether it's a shock scenario or whether or not it is a protracted slowdown that leads to increased losses and illiquidity in the private sector and problems for the financial sector, I think either one, it's fair to say we can look, it will have a lower or reduced lending volume that we'll see. There will be much tighter lending, and that we would see also maybe a stop in lending if credit conditions would become credit channels would become blocked. Slower economic growth, additional job losses, and as we've seen, and we're not suggesting it here, but that certainly it creates greater tensions in the social side and social unrest. Thank you, Leslie.
Now I'd like to ask Lori to join in and to cover some of the potential actions that can be taken by USAID or even government policymakers to prepare for and to address these risks that Scott and I have talked about. Lori?
Yes, thank you very much, Leslie, and we do appreciate everyone participating. What I wanted to talk about is the potential actions by USAID or other donors. I think a lot of us sit back and look at these issues and say, oh no, what can we really do? And there are steps that USAID should be thinking about. As Leslie and Scott have covered, it's not just the financial sector that will be impacted by these crises, be it a shock to the system or a slow continued deterioration, but it will impact the real economy, impact jobs, impact the real sector, impact even social stability at times. And so what we want to do is provide some high-level thoughts of what you should be thinking of. The positive is, Leslie did mention that many of the countries that we have the most concerns with, which is high contagion due to pan-European banks or high levels of non-performing assets, those countries already have existing USAID programs, many working in access to finance, some in the financial sector, private sector growth. So there is a way to quickly go in and do a few tasks. One of the items that we're recommending, and for those of you that have seen our actual technical brief, we did include in the appendix a crisis preparedness checklist. What that is intended to do is give you a basis for the economic governance officers, for other advisors working on your programs, to go through and work with the potential stakeholders in a country to determine if they are prepared. What we see many times, and we all do it personally, we say, yes, yes, we're ready for a crisis. But the key is everybody on board that needs to be on board? For instance, if there were to be a financial sector meltdown or trouble, you would have to have the central bank involved, the ministries of finance, the deposit insurance companies, if there is one in the country, as well as all the supervisors if they're not directly part of the central bank. Many times the capital markets supervisors are outside of the central bank. And so those individuals need to work together and have a mandate in place that basically puts them all at the table together, gives them the authority to act, and also to move quickly and decisively. One thing that we all have seen is if the communications and actions aren't taken decisive and quickly and to enough of an extent, it only exacerbates the problem further. So one of the points that we recommend is that, does the country have a mandate? Have they brought together all the key players? Secondly, do they have a communications plan? As we said, a key is a single spokesperson or identified spokespersons. You don't want the Ministry of Finance giving one message and the central bank governor giving a second message. So this is very critical, and we've seen it in prior crises. Next is we recommend that every country be well aware of who their systemically important financial institutions are. That is actually a new terminology that all of us are becoming more and more familiar with the ongoing crisis here in the U.S. and other countries. As Scott pointed out, many times you think you know who owns your institutions or what they're involved with, but have you looked far enough into the organizational structure? For instance, Scott talked about Unicredit and the ownership in Serbia as well as Italy, or Austria and Italy. The other question that is very important is, do they also own pension funds? Do they have insurance companies? And what is the impact to that organization as a whole if the bank were to be illiquid or had to be taken over, or just restrictions in capital? So that is very important. A detail that's in there that many times you don't even think about is, do you know who the chairmen are of those financial institutions and how to get in touch with them? Very simple, but once again, who do you call if something was to go wrong? Lastly, in the crisis preparedness, the emphasis that we give is, what liquidity options are in place? Are there additional lending facilities? Does the central bank have the permission to step in quickly and revive lending or give liquidity to a major institution? And what are the collateral requirements? So the key here is just being ready, knowing the potential for problems, and having started that communication process before it gets worse. Next slide, Leslie. Another action that we're recommending for USAID, as well as other donors to think about, and even the countries themselves, is, what is the potential impact of a fallout if there is a sovereign debt event in your country or in the region? What is the impact to trade, as well as future programs that USAID may be considering? This is something that in some of the charts that were shown previously, we show the correlation between countries. And if one sector and country starts to go down, what is the downside effect on Albania and their trade or their private sector growth? So what we're recommending is that it's something that is taken into consideration when designing new projects as well as country strategies. And what is the longer term impact? Many times we just think about jobs, but it could have an impact on demand in the agricultural sector. It could have an impact on some of the gender-related programs. If banks are starting to tighten credit, potentially women or minorities in a country may not have that ability, and therefore hurt access to finance overall. Our third recommendation is to look at opportunities and be ready to provide interim technical assistance to financial authorities or potentially to the private sector, if that is part of your strategy, on the various crisis-related topics. Not only does the government have to be ready for contingencies and problems, so do the individual institutions. Where will they get their liquidity or capital from, if necessary? Can they go back to the parents? Or what are the agreements between the parent organizations if they are owned by foreign entities? Also, individual institutions should be looking at their crisis management planning, as well as how will they deal with the level of problem loans, and if they do get larger. As everyone knows, problem loans are typically a multi-year effort and do cost lots of money and time in dealing with them to work through them. Lastly, we could think about working with countries on, are they prepared for resolutions? If they had to liquidate an institution or look for a buyer, do they have that capability within the deposit insurance entity or the supervisory entities? Macroprudential is also listed on the slide, where it is something that is being looked at more and more. What is the overall systemic impact to a country's financial sector? Many times it is something that everyone is starting to just grapple with. How do we look at that? But that could give some of the insight into which institutions are potentially more challenged should the overall economic picture continue to deteriorate. Let's move on to the next slide. And our last recommendations stem around working closely with the other IFIs and donors. We talk about holding talks as well as coordinating and cooperating. We are very aware that the IMF, the EBRD, and the World Bank are actively engaged in these areas, working with individual countries on their programs. It is something that we do believe that USAID, PFS, or your other programs could also have a major contribution to, coming back to the idea of dealing with the contingency plans, dealing with problem loans in institutions, and also just the crisis preparedness preparation. So we would recommend that USAID look very closely at what the other donors are doing and see if there's complementary actions. And part of the real key and driver for our recommendations is in the majority of these countries that we're talking about, USAID has had substantial progress over the many, many years. And it is on the cusp that things could go forward or they could go backwards. So we're trying to really recommend areas that will help everything stay status quo and that the organizations and supervisory entities, financial institutions can move forward as the global markets start to change. Lastly, a recommendation, although it's not on this chart, would be considering how do the institutions and entities implement the potential new best practices that will be coming on board from this global crisis. We're already starting to see it with discussions of Basel III, with new liquidity and capital requirements, and we all know that here in even developed countries as well as our transitional economies, the skills and the capabilities to move forward may be challenged given the other priorities they have with working with the troubles they're involved with. So Leslie, I will turn it back to you. Leslie, are you doing summary and conclusions?
Yes, thank you. I had my microphone muted there for a moment. Thanks, Lori. Yeah, I'd like to summarize everything that we spoke about before we open it up for discussion and questions and answers. First of all, we talked about why the financial sector is so important, such an important element for sustainable economic growth. Without credit flowing to businesses and individuals, without payments flowing around the economy, it's very, very difficult for economic growth to be strong. Then we talked about the challenges posed by the European debt crisis to the countries in Southeast Europe and Eurasia. We talked about the points of vulnerability really being the linkages between the banks, which are in many cases, the banks in Southeast Europe and Eurasia are owned by banks from the Eurozone. They control some of the largest banks in almost all the countries in Southeast Europe and some of our Eurasian countries as well. We talked about the trade linkages being important because those countries that rely on trade with the vulnerable countries in the European Union will probably see their economic activity decline if things don't get better in the Eurozone quickly. And we talked about macroeconomic and banking sector fragility or vulnerability. In many of these countries, the conditions are already weak in terms of the health of the banking sector and the overall macro economy. So if a shock does come, those countries are going to be not in a good position to deal with that. So then Scott talked about the possible effects in Southeast Europe and Eurasia from the Eurozone crisis. First of all, there's a potential shock scenario which would be transmitted through the financial sector. This, I mean, I don't want to say anything that would be prophetic and cause bad things to happen, but let's say, for example, that one country decides to exit from the Eurozone, or another example might be if a major bank were to go down in the European Union, particularly if it had ties to the beneficiary countries that we're talking about in Southeast Europe and Eurasia. If that were to happen, then the shocks would be transmitted directly through the financial sector and lead to a slowdown in economic growth and probably to very serious credit crunches in these countries. And the other scenario is that, okay, a shock doesn't happen, Europe manages to muddle through its crisis and its problems, but it will still have a long recovery ahead of itself as it works through its high levels of debt and its other issues. In that case, we would see protracted slowdown in economic activity in Southeast Europe and Eurasia, delayed economic recoveries, and again, cutbacks in lending, decreased access to finance for small and large businesses alike, more job losses, and basically more pain in the countries where we're focusing our efforts today. And then Lori summarized for us some of the actions that can be taken by USA, by other donors, and actually by policymakers in the target countries. First of all, they all need to understand what are the operating dynamics. They need to understand the banking situation and the challenges that they're being faced with in this crisis in order to be prepared to take actions, making sure that the authorities are prepared to respond swiftly. Lori talked about the crisis management checklist, which is contained in the technical brief that we're discussing today as an appendix. Of course, it's much more detailed than what you saw in that slide a few minutes ago. So basically, our recommendations are that USAID, other organizations, policymakers, take a step back, check whether they are fully prepared and fully aware of all the issues. None of us can actually prevent this from happening, but we can be prepared to do as much as possible to soften the blow if and when it does come. And that's the end of our actual presentation today. And now we would like to give those of you who have called in the opportunity to submit some questions or to have a bit of a discussion with us about the issues that we've talked about. So this is your opportunity to do so. You see here on your screen some instructions. If you want to talk, you can click the button to raise your hand, and your microphone will be activated, or your telephone will be activated if you called in by phone, and you can just ask your question. And if that doesn't work, or you don't have audio on your computer, then you can submit a question in writing in the chat box, which you see near the bottom of that taskbar on the right-hand side of your screen. So I encourage anyone who's listening to us today to either raise their hand or to submit some questions to us in the chat box. And if we don't have any coming from the audience, we have some of our own which are prepared, which I will turn back to our panelists. Maybe I will do that first. And while they're answering my question, some of you in the audience can submit your questions as well. So Lori and Scott, what about the question that we sometimes hear? You know, people say to us, well, you talk about the European debt crisis and you talk about this potential for contagion all the time. As Lori said, we're all getting tired. I think Scott said we're getting tired of hearing about it. Even those of us who are professional financial sector persons, we get tired of it. But we hear, Well, the banks in my country, let's say country X in Southeast Europe, they're really well capitalized and they're actually profitable. So we don't have to worry about any of this affecting us. Scott, what would be your answer to that?
I think what I would say is that that could be a false sense of comfort. I think those are wonderful things to have, and certainly it's a good starting place to have very strong capital. But that if we look at it historically, banks, when they fail quickly, not through traditional credit problem insolvencies, but banks that have had to be, I think, either bailed out or banks that have been determined to put in conservatorship have frequently done that through liquidity. And that unless these banks, these central banks, in these countries have limited capacity to provide liquidity and monetize any problems that happen, that could be a real, I think, quick way to have a significant downturn in the financial health of the overall financial sector or any individual institution. So I think liquidity, those numbers on, whether it's they're making money and how much capital they have, it may not be a true picture of liquidity when you really get into a stressed or strained liquidity environment. And I would say that it wasn't that long ago we were hearing about the pan-European and Western European banks that were liquid, and even some of the banks that many analysts believe have lots of liquidity found themselves in the last weeks unable to fund themselves in the wholesale markets because of a complete freeze in the interbank market. And as I mentioned in some of the earlier comments, a number of these large banks, and when I say they are dependent upon ECB, the European Central Bank, for their liquidity, this is a dynamic that has been in place for in excess of a year now, where they have been relying on the ECB. So I think that I would go back to where I started and say it could be a false sense of comfort and better to be prepared than trying to remedy these things after the crisis or the problem hits. I don't know, Lori, if you have something you'd like to say on that.
The only comment that I would make is that it is very difficult to measure confidence, and it's very difficult to measure or be able to predict what financial sector participants, be it individual consumers, large money fund managers, will do. Obviously, banking is a risk-averse environment, and that is the biggest challenge. And it's really just repeating what Scott is saying and just confirming that you cannot measure confidence or accurately understand how people may respond.
Okay, thanks, Lori and Scott. We received another question through the chat box from colleagues at the Albanian Financial Services Authority. They say that they've read an article in the Financial Times that some of the big European banks are making contingency plans, it says, against the euro in case the worst happens. I presume what he means is that in case the euro breaks up, or in case some large banks in the Eurozone were to collapse. What would you say to that? Let's start with Scott. How would that affect the countries in Southeast Europe or Eurasia that are most highly exposed to the European debt crisis? The worst case scenario.
Well, I guess I would start by saying I don't think anybody knows for sure, and you can read just about anything you pick up. There are all different ideas and thoughts on this. And where I would say is, at this point in time, there is not a mechanism, a legal mechanism that exists for exiting the euro. Now, certainly there's a lot of discussion about that, in fact, discussion of a breakup of the euro. I think I would go back to one of the comments I made earlier, which is that it's about how orderly this is or how disorderly this is. And that when we look at, I think, whether that's investors, customers, any counterparty, they like certainty, they don't like surprises, they like knowing where things are going to end. And that I think that there are banks thinking about this and planning for this, but it really is uncharted territory. And so I know that's not a real answer to the question, but I think that it's because nobody has a real answer to the question, but that it's at least good for those institutions that are doing that, you know, thinking about it, planning for it, and having ideas and strategies and contingency plans. That is all positive, but I do think that there are so many unknowns here that it is going to be a very difficult thing to navigate if that comes to fruition.
Lori, what would you think might be the repercussions, let's say, if a bank were to fail or to be taken over by its government that has its subsidiaries all over the Southeast Europe region? I don't want to name any names or anything. I'm just speaking totally hypothetically at the moment. But let's say one of these banks that's present in a number of countries in Southeast Europe were to be nationalized or were to experience major problems in its home country. What do you think might be the impact in Southeast Europe?
I believe the first impact, and once again, I'm always saying we don't want to be gloom and doom. However, if that news were to break, I believe the first impact would be a deposit run. Many individuals in Southeastern Europe, in the transitional economies, do not have the full confidence that their deposits are protected. So I think the country that it occurred in would need to be ready, the central bank would need to be ready to provide sufficient funds or monies so that if there is a deposit run, that you could try to alleviate some of the concern by being able to meet those demands. I then think it would be a lot of confusion because this hasn't happened in these environments, and it would all come down to how does the large parent bank view the subsidiaries in the individual countries. And so I think in the early days it would be holding it together by a country, helping to maintain enough confidence so there is not contagion across other institutions, and then immediately working with the foreign supervisors from the lead countries to understand the next steps. Liquidity for deposits would be necessary, potential liquidity in the interbank markets, as well as soon thereafter increase in capital adequacy ratios to build and bolster confidence.
Mm-hmm. One of the things that PFS has been doing in the last several months. Go ahead, Scott.
No, that's okay. Go ahead.
Okay. I was just going to mention some of PFS's activities over the last several months where we've been working with deposit insurance authorities in Southeast Europe to help assess their readiness to deal with a crisis, basically by helping them assess their conformance with international standards for deposit insurers. It's called the Core Principles for Effective Deposit Insurance Systems. And we believe that we've helped the deposit insurers, by and large, to increase their awareness of potential, let's say, potential problems that they might face in the event of a large bank failure or a number of bank failures, and to improve their readiness to deal with it. All the countries that we spoke about as being highly vulnerable to the crisis do have deposit insurance. In fact, all of the 12 PFS countries have deposit insurance systems except for Kosovo, which is in the process of implementing a new system, and Georgia, which does not have deposit insurance, but it wasn't at the top of our list of vulnerable countries. You know, deposit insurance helps people, if they're aware of it, to know that their deposits are actually safe in the banks, if they're within the insured limit, and it is there to keep them from panicking. But we saw in the 2008 crisis and early 2009 just exactly what Lori said, which was that in most of the countries, depositors did panic when they started to see the problems from the United States in the subprime mortgage lending market spread to the European banks, basically spreading to the parent banks. And today, those parent banks are even in much worse condition than they were in 2008. So that heightens the risk, but hopefully deposit insurers are a little bit better prepared to deal with any potential crisis. Scott, what were you going to add?
I agree with confidence is at the heart of so much of this, but I think one of the things I was just going to mention was that as we talk about deposit runs, particularly in Southeast Europe, where many of these economies are Euroized, I think what will be very interesting and difficult to try and plan for is that in the 2008, around the end of the year, when you had a number of these countries experiencing deposit runs, people were getting their money or trying to get their money out of banks and having it in euros. This time, what currency would that be that they would want if they wanted hard currency in their possession? And then I think the other question to that is are the central banks sufficiently supplied with those currencies that they can get them out to the banks quickly enough that you don't, in fact, create a problem where depositors go in and they want Swiss francs or U.S. dollars or whatever the currency might be, and that they have to basically ration how much people can withdraw because the banks themselves don't have enough of that particular hard currency. And this ties back into, during the presentation, about contingency planning and how important it is for not only the financial institutions themselves, but also the regulators, the policymakers, and others to be prepared.
Yeah, and that issue about having sufficient supply of banknotes on hand, it's also mentioned in the crisis preparedness checklist that Lori summarized for us, and which is one of the appendices in the technical brief itself. So maybe our colleagues from Albania and other countries that are listening today, they might want to take a look at that crisis preparedness checklist in the appendix to the technical brief and just walk through it on their own to assess their readiness to deal with a crisis. Is there anyone else in the audience that wanted to submit a question, either by raising your hand or by submitting a written question? We're not seeing any others coming in. In that case, I will submit one more question to our panel, which we'll answer on our own, and if we don't hear anything else from the audience, we'll wrap up at that point. Scott, I've heard from some of the, let's say, well-informed people in some of the target countries that we've been discussing today that they're not so concerned about the high level of problem loans in their country. They think that 10, 15% of loans being non-performing is something that the banks can handle, and that they're not really very concerned about that. What can you say to our audience about how non-performing loans impact a bank or impact a banking system at the systemic level, and what are the negative effects that can happen by banks having such high levels of problem loans, particularly in a crisis or potential crisis situation, as we've been discussing today?
Well, I think that anytime any bank in any system enters into a crisis, it is good if you don't enter into it with elevated problem loans, because it's, I think, generally, I'm not aware of any situation where crisis that has impacted systemically a group of financial institutions where ultimately it hasn't resulted in problem loans. So even if you're at 10 or 12 or even 15% today, the question is how much more can the system handle, whether that comes in the form of very quickly, if it's a shock scenario, or more slowly in the form of a long-term. But I think that it has other implications rather than, maybe there are substantial reserves to cover those non-performing loans. And yes, maybe there is profits even with those elevated levels of problem loans. But another consideration is as you have a more nervous market in even these countries domestically, there may be a decreased willingness in the local interbank markets to have counterparties with that bank on transactions or liquidity in terms of selling or passing excess funds, or even doing any type of business, because the other banks may say, well, that they are more troubled. So I think what I would say to that is, again, it's good if you have strong capital. It's good if you have strong reserves. But I've never seen a situation where elevated problem loans should not be a concern. And that I think if you're talking about entering into another round of crisis, that it is likely that there could be added additional problem loans to the levels you already have.
Thank you, Scott. Lori, would you add anything to that?
I would only comment that even with the levels that are reported, there is a lot of variability between countries and how they report problems. And so the measurement is somewhat suspect in that some countries report problems even if restructured, and some do not. And so there's a lot of variabilities in comparing one country to the other. However, I think the point that Scott makes that's most critical is working through problems is very expensive. It's expensive in the cost of capital, it's expensive in the cost of human capital, and it prevents institutions from being able to go out and do other types of lending or other types of business development.
Yeah, actually, it means that banks are basically unable to lend because they're concentrating their resources on focusing on collecting the problem loans that they already have. And if a crisis comes along, those problem loans will probably become even more problematic. I mean, borrowers will stop paying at all, and that increases the bank's liquidity problems, its cash flow difficulties, and makes that bank even more vulnerable to any potential new fallout. And of course, makes it even more difficult for sound and healthy businesses to be able to obtain credit, which is really the big factor that permeates through the economy when credit is restricted. Okay. I would like to thank everyone for joining us today to talk about the crisis in Europe and the PFS program technical brief about the potential for contagion in Southeast Europe and Eurasia. I'd like to remind you that this technical brief is the fourth technical brief that PFS has produced in a series of quarterly briefs that we'll be issuing throughout the life of the PFS program. And the other three are listed at the bottom of the screen here. And you can find all of them on our website, which is www.pfsprogram.org. And if you have any other questions or comments about the topics that we discussed today, you can contact us through the website there, and we'll be happy to get back to you and try to answer your questions and to implement your suggestions and to continue this important debate about the potential for economic contagion in Southeast Europe and Eurasia. Thank you, everyone, and have a good rest of the day.